Hey, hi, this is Kirubakaran Rajendran. Welcome to another video series with Groww. So in this video, we're going to talk about what is algorithmic trading and how retail users can get started with it. So when people talk about algo trading or algorithmic trading, many people tend to think it is kind of a complex systems where any retail traders can't get started with it. You need to have a lot of programming knowledge, or only people who have huge capital can get started with algorithmic trading. So there are many misconceptions about algorithmic trading. So in this video, we'll clear everything about it. So to get started, first of all, to know what is algorithmic trading. See, by definition or in general, algorithmic trading is nothing but when you have a set of rules and you feed in these rules to the system to execute trades on behalf of you. Say, suppose you are manually placing a trade, or you are manually taking a trading decisions. So how do you take a trading decisions? So for an example, you tend to observe some stocks and you say, okay, if I wanted to buy a stock when it trades above 200-day moving average, or I wanted to sell the stock when it trades below 200-day moving average. Now, what would be my result? Like if I go and deploy this as a rules, if I go and create this as an algo rules and then deploy it, what would be my results? So these are something which you can quantify it, where you have predefined rules which you can quantify it, because the system can understand your logic, because your logic is directly quantifiable in nature, where you are stating to the system that go and buy the stock when it trades above 200-day moving average, or sell it when it below 200-day moving average. So these things are quantifiable in nature, where the system can easily execute, and you can consider this as an algorithmic trading. But for an example, if you follow a visual chart pattern, say suppose there are old traders who follow technical analysis patterns, chart patterns. For an example, I wanted to find out list of stocks which creates head and shoulder pattern, cup and handle pattern. So these are visual chart patterns, and it is not very clear in objective. It is subjective in nature, where you can't clearly define or quantify the rules. So for the first and foremost rule with respect to algo trading is you need to quantify the rules for your entry and exit, so that the system can understand and execute it for you. So algo trading is nothing but these kind of defined rules. When it given to the system, it is able to execute the trades for you. So when it comes to trading or investing, you tend to keep on taking multiple decisions. So as a discretionary trader or a discretionary investor, you observe what is the news and you see what people are talking about specific stock or specific indices, and then accordingly you take your trading decisions. So when you don't follow algorithmic trading, or when you don't follow rule-based trading, you would purely follow your own intuition, your own gut feeling, based on your own experience. You tend to take those trading decisions or investing decisions. But let me help you with an example which would clearly state how following a rule-based investing can greatly help you to take the right trading decisions or investing decisions. So the chart that you see right now is nothing but the chart of S Bank. So as you all know, by 2018 around September, both S Bank and DHFL, both the stock crashed more than 45% on single day. So as a normal retail investor, every single investor would have tend to panic seeing their stock or portfolio going down 50%. So now if they have to make a trading decisions, they largely rely on news, like, okay, why a stock is going down. First thing is, the moment the stock went down 50%, many people will tend to think, okay, it is available at a very attractive price, so let me go and buy it. But many large investors or retail investors, what they tend to do is, okay, I have huge holdings now, but I can't exit with a 50% loss, so let me wait for the news to confirm what is happening with the stock. But when you wait for the news with respect to S Bank or DHFL, what happened was the news came in much later point of time about the loan scams and everything, and eventually the stock crashed more than 85% or 90%. So if we wait for the news, then definitely it will be too late. So what is the right way to take an investing decision with respect to these kind of scenarios? So let me explain that. So after that day, both S Bank and DHFL crashed 40%, right? So now I wanted to find out the historical data analysis. So this is a right example of what algo trading is all about, or based on rule-based investing is all about. So we know both the stocks were part of FNO. So now I just went to NSE website and downloaded all the historical data of stocks in an Excel format to see what are the list of stocks which has crashed more than 40% in one single day. That is also part of FNO, because stocks which are part of FNO doesn't have filter circuits, so it can keep going down. So what are the list of stocks that has crashed more than 40% in a single day? that are part of FNO. So once I ran this analysis, I got list of stocks. So for companies like Satyam Computers, which crashed more than 70% in a single day, companies like Financial Technologies, Core Education, GTL, Unitech, Puravankra, Kruti, a lot many stocks were there. So all these stocks crashed more than 40% in a single day. And what are the respective years and date and time also I've got it. So now I need to figure out, okay, there are certain stocks which crashed in 2009, 2013, 2011, 2008. Okay. So what happened to these stocks after 2 or 3 years eventually? So that is what I wanted to find out. If I could find that out, then I have a higher probability to know the fate of DHFL and SPAC, because that also crashed more than 40%. So historically, if any of the stocks also crashed more than 40%, what would happen to them? If I check that, then I'll have an idea to take a investing decision with respect to DHFL and SPAC. So what I found out is, whatever the stocks that has crashed more than 40% in one single day, eventually all these stocks started trading as a penny stock. It was not able to recover from that huge crash. So the moment it crashed 40%, it was not even able to break that previous high level at all. So this company, Financial Technologies, after it crashed, it eventually started trading as a penny stock. Even the same happened with respect to Core Education as well. So after the stock crashed, the stock was not able to move back to its previous levels, and it started trading as a penny stock after 2 or 3 years. And the same fate goes to GTL stock also. So even that stock, after crashing more than 40%, eventually that also started trading as a penny stock. So all these examples led me to just one point, which states that a stock which has crashed more than 40% in a single day, which is part of FNO, has a higher probability based on historical data that it can eventually trade as a penny stock. So there is nothing as such 100% guarantee with respect to markets. But when you're not able to make investing decisions, like for an example, when the market crashed 40%, both S-Bank and DHFL tanked, right? So you are clueless what is happening. So instead of waiting for the news, if you go and analyze these historical data, it is going to tell you what has happened really in the past. So based on that, you would be able to make the right decisions. So based on that, I was able to exit the stock, both the stock, S-Bank and DHFL, on that day. The next day, even though it is loss of 50%, I accepted it, because if I wait for few more months, I'm going to lose more than 50%. So it's better to accept my loss and then come out. So eventually what happened? So both S-Bank and DHFL went to the same territory. It went into a penny stock. So that is what historical data analysis greatly helps you. So when you go by these algorithmic rules or system-based rules, which analyzes and tells you what needs to be done, it greatly helps you to make the right decisions at the right time. So we know within few years, DHFL went for a bankruptcy where it was delisted and all the investors lost money. So people who hoped that it would recover, they eventually lost money. And the same goes with S-Bank as well. So S-Bank, even after multiple years, it was not able to go back to its previous levels. So people who thought, okay, S-Bank is the next HDFC, next Kotak, no, it is not going to happen, because that is what the historical data also suggested. So with respect to investing or trading, one thing that greatly affects the overall performance of a trader or an investor is his own emotions. So his own emotion comes in the kind of greed or the kind of fear. When the stock goes in your favor, you tend to get more greed. You tend to wait for more time, so that you wanted to make it as a multi-bagger returns. Similarly, if a stock goes against you, you have this fear, you have this panic, because you don't want to book that loss. You are in a hope that the market might recover and it might come back to its previous buy level, so that you can exit at a break even. So all these emotions will come and kick in when you are a discretionary trader or a discretionary investor. But when you start following this algorithmic trading or algorithmic investing or rule-based investing, what happens is you are going to follow a set of rules. So only when the rule says buy, you're going to buy. When the rule says sell, you're going to exit. So there is lesser part of emotions that plays here. So because only when you do not know what needs to be done, all these emotions will play around and all these emotions will kick in. But when you precisely know this is what's going to happen and this is what I'm supposed to do when X happens or when Y happens, you have the clear set of rules. So you will not panic, you exactly know what needs to be done. So the biggest advantage of algo trading or algorithmic trading is that it helps you to take the right decisions, and also it able to control your emotions to a greater extent. So algorithmic trading will not remove the emotions completely, but it will help you greatly to control your emotions, so that whenever a certain things goes against you, it is in your control. And also it helps you with the faster execution with the large data sets. So as I said you in the last example, where you saw that DHFL and S-Bank crashed 40%, but in order to find what needs to be done, you are gathering large set of data and doing the data analysis and data crunching, and then you are able to figure out what happened in the past within few minutes. So if you are a manual trader who do not follow algorithmic trading, so what would you do? You go and check manually all these charts, and you go and check manually what happened in the past, and in order to come up with the final conclusion, it will take you, multiple hours or multiple days also. But when you follow these algorithmic trading process, then you are going to get it done within few minutes. So all you have to do is just do the analysis and write a small programming, or just do the analysis in Excel itself, and you will be able to come to a conclusion. So algorithmic trading greatly helps you for a faster execution, and also it helps you with the faster analysis of historical data so that you could take the right decision. So now you decided, okay, fine, algorithmic trading greatly helps. Now I wanted to get started with it. So how do I get started with it? So there are a couple of things which could greatly help you out. So first thing is, you need to start with the trading platform which offers you algorithmic trading. So currently there are multiple brokers out there in India. So compared to 10 years before, now there are a lot many brokers are providing algorithmic platforms directly to the retail users. So you need to find out what are the list of brokers who could help you with these algorithmic trading platforms. And also there are many brokers who provide free APIs as well. So with using the API, people can program it and automate the trades. So you need to find out what are the list of brokers who could help you with these APIs, and based on that you could write your own programming part. You can just program all your trading rules and then put it into a server which is going to execute all the trades for you. So the first and foremost thing is, find out the suitable trading platforms which offers all this algorithmic trading. And I would always say, see, there are good traders and there are good coders, but there are no good coders or no good traders who can do both. So when you have a combination of a good trader as well as a good coder, then you can do wonders, because not only you are having a trading knowledge, the moment you start possessing or start learning more about coding, then what happens is you could do wonders with your trading strategies. You could create trading strategies, you could analyze large amount of data sets. So there are multiple things that you could do. So it is not necessary that only a person who is having a coding background or a computer background can get started with algorithmic trading. So there are multiple no-code platforms available out there which would help you out to backtest any kind of trading strategies. So platforms like Algo test, platforms like StockMark and Quantman, multiple platforms are there where even if you do not know about coding, they could help you out with the backtest. So you can it's kind of a drag and drop. So for an example, 15 years, 20 years before, when you have to create a website, you need to know all this HTML programming knowledge, and then to create a website, you have to undergo multiple layers of codes lines, and then the site goes live. But now there are easy way to create websites, right, where you can just drag and drop and your website is ready within few minutes. Similar to that, if you have to create a trading strategy, you don't need to write codes, thousands of lines. There are multiple no-code platforms available there. Using simple drag and drop, you would be able to quantify certain rules, test certain logics and backtest it, and then you can easily deploy it also. So if you wanted to develop your own trading strategies, or if you wanted to learn programming by yourself, there are ample of resources available in YouTube. So most of the traders, the programming language that they use is Python. So multiple people, they use Python to not only to backtest, to deploy the systems, to execute it live also. So if you are looking for certain Python courses to get started with, there is one course in Udemy where it is one of the famous algorithmic trading course. So if you just go and search in Udemy, you would be able to find a lot many algorithmic trading courses out there specifically for Indian market. So you can see, if you sort it based on highest ratings, you will find one of the course which is used by multiple thousands of users who have given top rating. So you could choose that specific trading course, and even if you do not know anything about programming knowledge, they teach you from the basics. So that is one course which I would highly recommend you to get started with. Other than that, there are multiple courses out there in YouTube where if you just Google about Python trading, or just wanted to learn basics about Python trading, then you will have ample of resources to get started with. So once you have all these things in place, the first and foremost thing is to develop a trading strategy. So how do I develop a trading strategy? So generally what I do is, if I have an idea in my mind, for an example, I wanted to go with a trend following strategy. So my trading assumption is, okay, many stocks will trend sometime. So if I could capture those trending moves, then I can make a huge profits by end of the year. So next thing is, I've decided trend following. Now I need to find out what kind of systems that I can create which could help me to capture these trends. So once you Google about it, then you will know like indicators like super trend could help you out to capture the trend. Indicators like Don Chain channel, which can help you like 20 days breakout or 50 days breakout. Once a stock goes above last 20 days high, it tends to move up further. Once a stock breaks last 50 days high, it tends to move up further. So these are some things which you can directly test it. So if I just have super trend, I wanted to go long when a stock goes above the super trend in a 30-minute time frame, or whenever on a daily time frame, when if a stock breaks last 50 days high, buy it. When a stock breaks last 50 days low, let's sell it. Or you can even go to a larger time frame stating whenever a stock hits 52-week high, I will buy it. And I'll hold it as long as the stock trades above 52-week high. The moment it goes and touches 52-week low, I'll exit it. So these are some of the larger time frame rules which can help you out. So for an example, when you're following this 52-week high low strategy, you will be able to capture multiple multi-bagger stocks. So a stock that breaks 52-week high will continue to make new 52-week high. So this way you would be able to hold large multi-bagger stocks. If you're going for a very shorter time frame, then you can go for last 20 days high or 20 days low. So these are some things which first you need to find out, okay, trend following is something that I wanted to follow. And from there you are listing out what are the list of strategies that complements this trend following nature, and then you're going and testing it. So once you create these rules, then you have to go and test it using the historical data sets, and you have to find out back test it. So that is what the testing means. So once you back test it, then you will have an idea, okay, whatever the strategies that I talked about, whether it's working or not. So that is what backtesting is all about. So basically, before putting your capital in live markets with respect to algo trading, you wanted to find out whether the strategy is working fine or not. So for that, backtesting is going to greatly help you out, where once you start backtesting, it is going to precisely tell you, okay, the strategy has worked this much, the strategy has not worked this year, probably this is the maximum loss that it is given, or this is the maximum drawdown it is given. So you will have a complete statistics. What is the winning ratio, what is the losing ratio, what is the risk reward ratio. So once you have all these details, then you can plan your risk management, money management from on top of that, and then you can go and deploy the live trading. So one more thing that you need to keep in mind is, once you have done all this part, and then once you're coming to the live trading part, do not put all your capital and start directly with live trading with respect to algorithmic trading, because you need to find out whether whatever the strategy that you have backtested is giving a similar returns in the live markets. So for that, you need to do a forward testing. So forward testing is nothing but you just play around with one lot or two lot and trade it live with at least for 1 month or 2 months, and observe how the system is working, whether it is matching with your backtest or not. Because sometimes the backtest results will give you super good results, but in live markets it might not give you, because in the backtest you would have not considered slippages, transaction charges, because not just 20 rupees brokerage is only cost. Addition to 20 rupees brokerage, you have exchange transaction charges, you have SEBI fee, you have GST, you have multiple other charges. So after detecting all these charges only, you will have the net results. So you need to find out whether your forward test results is matching with your back test results or not. So that is why when you create a trading strategy during your initial days, with respect to algorithmic trading, keep in one thing in mind: do not take more number of trades. So just because you could automate it completely, you don't need to manually enter the trades. Don't give too many number of trades, or don't try to develop a trading strategy that can create too many number of trades, because it is going to increase your overall transaction cost. So keep those things in mind, and then create a trading strategy, so that somehow your backtest and live results will match up to an extent. So there is no way 100% of your live results will match with your backtest results, but even if it matches 70 or 75%, that is still good. So algorithmic trading, one more misconception people have is algorithmic trading is like, okay, once I'm done with it, once I create a trading strategy, automate it, put it in a server, I can just go and relax, have an holiday. I don't need to monitor it all. No, in algorithmic trading, multiple endpoints can go wrong. The broker API might go down, your server might go down, the live data feed might not get updated, or your order execution could be in pending state. So there are multiple layers out there which at any point of time can go down. So algorithmic trading needs monitoring. So whether you can automate this monitoring part, where if something goes wrong, you can get an automated telegram alert to your mobile stating, okay, something has gone wrong, and then you can go and fix it. But it is not something like, okay, I don't need to manually monitor at all. If I just create and leave it, it is automatically going to create money for me. No, that is not going to happen. So definitely algorithmic trading has its own risk. So definitely there is certain level of monitoring that needs to be done. So when you're creating algorithmic trading strategies, you need to keep these things in mind as well. So with respect to disadvantage of algorithmic trading is, now there is only one disadvantage I would say. It is mainly because people who are getting started with algorithmic trading in the recent days, what they'll do is they tend to curve fit the overall data. So what curve fitting means, for an example, in order to get the best results from the backtest, they tend to keep changing the parameter. For an example, you wanted to buy a stock when it trades above 200-day moving average, and you wanted to sell it when it goes below 200-day moving average. You backtest this and you see, okay, it has given some 40% year-on-year results, average returns. So now you wanted to increase this returns. You are not happy with this 40% yearly returns. So what you will do is, you will tend to find the best moving average parameter for any specific stock. So now what you will do is, instead of 200-day, you will say, okay, let us now do a moving average crossover. So instead of 2050, let me change the moving average crossover from 3949, 5862. So when you keep changing it, then the system, based on your input, it will keep doing the analysis and it will tell you. Then at one point of time, you will see, okay, probably instead of just 200-day moving average, if I use a moving average crossover of 69 plus 72, then it is giving me highest returns. So based on the backtest results, if this parameter is giving me highest returns, then I'm going to deploy the same parameter in the live market, so that whatever the huge returns that I've seen, I can get it. So this is a perfect curve fitting. So you are trying to fit the historical data with your own parameters to get the best results. So whatever that has happened in the past, the same set of frequency, the same set of whatever the parameters that has happened, the same set has to be repeated in the future to get these desired results. But definitely that is not going to happen. So all these outcomes are completely random in nature. So sometimes market moves up, sometimes it stays in sideways, sometimes again it goes in downtrend and uptrend. So these kind of market regimes keeps changing. So do not focus too much on the parameters when you're trying to develop an algorithmic trading strategy. Instead, just focus on the market behavior and accordingly create your overall trading strategy, so that you don't end up curve fitting the overall system. So this is what I wanted to convey in this video. So keep in mind that algorithmic trading is the future. That is where more people are going to shift. If you're a manual trader, definitely at one point of time you will burn out sitting in front of a system from 9 o'clock to 3 o'clock, keep on trading taking multiple trading decisions. Eventually you will get burned out. So that is why algorithmic trading can greatly help you, because you're not going to keep on taking multiple trading decisions. The system is going to take the trading decisions for you. So you just need to feed in the rules to the system, and based on that, the system is going to trade for you. So you put more and more effort in learning about algorithmic trading strategies, learning about historical data sets. How do I analyze all these data? So once you start focusing on all this part, then eventually the process becomes much simpler. So once you have the process, then the profit follows. So always focus on the process. So once you focus on the process, the profit comes eventually. So this is what I wanted to convey in this video. Thank you so much for your time.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.